Hi, welcome to another new video with Tankrich. This is our series on Warren Buffett partnership and shareholder letters, and today we're going to talk through the partnership letter for 1965 and 1966. Now, before I begin, I would want to remind you that you can post all your feedback and suggestions in the comments below on this video series or reach out to us on our Twitter handle @Tankrich. Now, moving on to the 1965 partnership letter. In the 1965 partnership letter, what I want you to take away from this video are two important investing lessons. The first one is Warren Buffett attempted to value companies conservatively. Now, again, I'll pick up his letter and try to quote him. He says that I attempt to apply a conservative valuation based upon my knowledge of assets, earning power, industry condition, and competitive position. So in this single quote itself, what he's trying to give us, he's trying to give us that the value of company is dependent on four things: assets, the physical assets which company owns; earning power, what is the earning power of those assets; the industry conditions, whether the industry has got tailwind or headwinds; and finally, the competitive position of company in that particular industry. So those are the factors which really drive valuations, and that's why you would tend to see that companies which operate in a monopolistic environment, which are favorable in industry conditions and have huge earning power, tend to be valued at a higher P than other companies. So those are the four important criteria which drive valuation. The second thing from this statement was, after understanding these four factors completely, he tries and applies a conservative valuation method, which means that he wants, if he goes wrong, he does not want to lose his capital. Remember what Warren Buffett has said: rule number one, never lose money, and rule number two, never forget the rule number one. So that's what we get as the first insight from this 1965 letter. Now, the second thing which we get from the 1965 letter, and again it was very comprehensive, comprehensively dealt in the 1965 letter, was his view on diversification. And again, I'll straight away jump into this one. Let me first quote him. He says that we diversify substantially less than most investment operations, which means that Warren Buffett has put his bets on few number of companies to outperform the Dow Jones. Now, again, hear it out what he says. He said that we might invest up to 40% of our net worth in a single security. 40% of his net worth, and that was running into millions at this point of time. So if he knows the company well, if he has understood all those four factors which we discussed, he is willing to put 40% of partnership asset into that company. Now again, he in the latter part of the letter, he clarified that those are very rare situations, and over his 8 to 9 year of partnership existence, this has happened only a couple of times that he has invested such a high amount of his partnership capital into a single company. Let me now put my interpretation on this particular topic. Imagine that you've got two companies, a company A and a company B. The expected return from both company A and company B in your portfolio is same. So what is expected return? Expected return is what is the profit that you're going to get from the outcome when you invest in that company, and what is the probability. It's a sum. It's a multiplication of both of these things that gives you the expected outcome. Now, knowing that the expected outcome from both company A and company B is going to be same, which company will you put more money? Warren Buffett has provided a very simplistic approach to this. He's saying that the company which has least probability of moving away from his objective, and his objective was beating Dow Jones year on year on a consistent basis. So if a company, let's talk about it in terms of standard deviation. So if a company has a standard deviation of 5% either way, of either beating Dow Jones or not beating Dow Jones, and the probability is 5% on the other side, and the second company has a probability of either side of 1%, he would tend to put more funds in the second company. So he'll go for company B, because even though the expected outcome for A and B is same, however, the probability of not meeting objectives of company B is closer to what is the goal of investing for Warren Buffett is. So I hope I've been able to put the right interpretation from this paragraphs, but that was his concept of going heavy on a company B instead of company A. Now the other thing that I've got here with me is the 1966 letter, and I have 4 important key takeaways for you from the 1966 letter. So let's look at them. The first one was importance of management. Now, for the first time in partnership history, Warren Buffett went on and actually invested in a private company. So he goes on and buys Hochschild Kohn and Company. I hope I pronounced that well. So that particular private business was a mental store, as has been laid out in the letter. Now, the line which attracted my attention was, listen what Warren Buffett has to say. He says that even if the price had been cheaper but the management had been run of the mill, we would have not bought the business. Now many a times when we go through the quotes of Warren Buffett, what does he say? He says that invest in a business which an idiot can run, because eventually a day will come when an idiot will run it. But what he is practicing, it is a little different. He is paying much more attention to what the management, who is running that business, who is operationally running that business. The second thing that we get from the 1966 letter is Warren Buffett's thought on timing of the market. Now that's pretty clear. He is not an advocate of timing the market, and if you read his letter, in his words he says that we tend to concentrate on what should happen and not when it should happen. So clearly he is advising retail investor, as well as he's professing that we should not time markets. Now the third important thing which we got from the 1966 letter was his take on emotions and investing. Now those were key lines for me in this letter, and I would read out for the benefit of people watching this video. Is he says that if we start deciding based on our guesses or emotions whether we will or won't participate in a business where we should have some long run edge, we are in trouble. So don't rely on emotions. Emotions are your biggest enemy when you are operating in stock markets. Remember, what did he say? Be fearful when others are greedy, and be greedy when others are fearful. That's going to should be your mantra when you're investing in stock markets. A lot of times, because of our emotional biases, we sell winners or we tend to hold on to losers. There are a gamut of emotional biases which in small retail investors have exhibited over the years, and that's why they have not been able to make anything out of stock markets. So keep the emotional bias outside when you're investing in equity markets. It is very tough, not something which you can learn overnight, but something very necessary if you want to succeed in investing. That was our third takeaway that we got from this. We got to learn from the 1966 letter was very subtle, wherein Warren Buffett pointed out that he used scuttle approach to understand the competitive strength of the company. And again, I would probably go down to the letter and read out a statement for you, which is here. It says that the various businesses that company operated were understandable, and we could check out the competitive strength and weakness thoroughly with competitors, distributors, customers, suppliers, and employees. So he went all around to understand what is actually the competitive strength of the company from all different angles. And this approach and the various techniques of this approach have been really detailed out in a great book by Philip A. Fisher, which is your Common Stocks and Uncommon Profits. It has been an investing marvel for last 4 decades. So if you get a chance, do go and read this book and learn the scuttlebutt techniques which Philip A. Fisher has shared with us. You have liked the video today, and now go back and read those partnership letters and share the investing insights which you have got in our comments, so that people who are watching this video get to know much more what's presented in this video. Hope you are liking this series. We are waiting for your feedback. Do post it. I'll see you again. Bye.